Hi, good afternoon. I'm Dan Hollander, and this is Sam Maxbauer. We're with Hollander & Lowe, and we're here to spend a few minutes with you talking about what really seems to be a wild run in the market. So we've had a ton of volatility, and we've got some calls, Sam. So what is the best thing, do you think, to say during these times when we have clients calling?
Well, it's important to let everybody know that we shouldn't be too emotional. We shouldn't let the TV or the newspapers scare us because volatility gives us a great opportunity to buy and get things on sale.
I think that's right, and oftentimes we liken it to buying tuna fish on sale because people go to the shopping market and they're looking for sale items, and tuna fish is pretty expensive to buy these days, but if you see tuna fish on sale for 85 cents a can, you might stock up on it. So similarly, when we're looking at the stock market, we want to look at companies and be able to determine if these companies are ones that forget the market right now, but we believe in them. We look at the research reports, that we look at the earnings, we look at the future, and then we look at the pipeline in terms of distribution, and we believe that these are companies that you could buy and hold for the long run. Then how do we feel about buying them in the first place? Do we buy them all at once, Sam, or come up with some other strategy?
So it wouldn't make sense to buy them all at once because we don't know that one day where the market's at the bottom. So we could split it up into sevenths and buy 1/7 on a very volatile day when the market's low, or maybe thirds, and that way we can spread out the purchases and keep the purchase price very low and try and get right at the bottom of the market. Do our best.
And do you do that similarly, Sam, for dogs in the portfolio? I mean, not everyone has a perfect portfolio, so are we, when we see some volatility, are we also looking to prune the portfolio, and if so, how do we do that?
When there's a lot of volatility, sometimes the prices go up, the market goes up, and then at that point in time, it might make sense to sell part of, or maybe all of, on the rare point in time, some of the stocks in the market or mutual funds in the market, and that way we can buy real low and try and get out right at the peak.
So there's a balancing that goes on, and it's never simply one or the other. And yet, going back to the issue that you raised in terms of emotions, how does that affect a portfolio if clients call and simply want to follow their emotions or what they've heard in the day's news to manage their portfolio?
Well, it's good to line of Warren Buffett, which is be greedy when people are fearful and be fearful when people are greedy. Because really, we want to do the opposite of what most emotions tell us to do, because it's very helpful in the market to capitalize on how other people are feeling emotionally.
And one of the things that I believe is where we really earn our keep is during these kind of times, but because clients need to know that we're looking at their portfolios carefully. We aren't letting our emotions get involved. We're trying to attend to long-term objectives, and even while we may feel some angst in the near term, if we structure the portfolios for the long term and we abide by that and look for opportunities, we're going to be in good shape, and that's historically been the case. And certainly we're proud of how our firm has addressed that. So even recently, in the past couple weeks, if people have been really suspicious of the market going in the wrong direction, our returns for the year are still quite substantial. So that a phone call or discussion is important. And we'd encourage you to speak to your advisor, speak to us, that is a means by which you can keep sane during crazy times. So we have other things that we like to talk about, such as ETFs and structured notes and other means by which you can hedge your portfolio. Those are a little bit more exotic, other things that we implement, but the basic things in the short run are to stay fully diversified, to be able to keep your emotions outside of the immediate investment decision-making process, and to subscribe to the philosophy that a good investor seeks to buy low and sell high, and we just put it in that frame of mind. Well, thanks for this afternoon. We look forward to speaking again. Thanks, Sam.